Wow, so the Bank of Canada came out with their report called Forecasting the Risks of the Canadian Economic Outlook, and inside they reveal that the chances of a worst case scenario playing out have absolutely skyrocketed. And it's a mix of all of the things that we talk about here on this channel just combining at the same time, and it explains why so many Canadians are feeling poorer and poorer. So let's dive into the details and figure out how we can better prepare ourselves for the increased chance of this actually happening. Here's the report that wasn't publicized too heavily, and it came out September 13th, forecasting the risks to the Canadian economic outlook at a daily frequency. Much of this report is very dense mathematics and dense calculations, but at the very end is what I want to show you. And this is the chart I want to show you. It's the probability of stagflation, and you can see that throughout the year 2022, this percentage chance that this would actually happen absolutely skyrocketed up to 30% as of the most recent reading, which was the end of last year. But what is stagflation? Well, economists tend to use this terminology that's confusing, and sometimes I actually think that's kind of by design, but that's beside the point. The truth is that it's actually very, very simple, and once you understand this one simple thing, everything else is going to make a lot more sense. Stagflation is the combination of two really troubling things. The first one is stagnation, and the second one is inflation. We've talked about inflation a ton on the channel, the increased costs of goods and services resulting in the average dollar buying less than it used to. But what is stagnation? Well, this talks about the slowing down or stalling, the halting of growth, and that's economic growth in Canada, largely measured by GDP, gross domestic product, in Canada. And it seems more and more like in this system, if things aren't constantly growing and growing and growing over time, well, that things start to break down, and this is the concern with stagnation. Let's get into it a little bit deeper. But you might be saying, Russell, when I hear politicians talk about the economy, they always seem to think that things are going pretty well, especially compared to other countries. I mean, just listen to our finance minister talk about our economy.
Canada, it has a AAA rating, notwithstanding the great investments we've made in Canadians. We have the lowest deficit in the G7, and we have the lowest debt to GDP ratio in the G7.
So she says things aren't that bad compared to other countries. Our deficit is not that huge, and our debt to GDP, the amount of debt the country has taken on as a whole, or the government has taken on as a whole, compared to our total economic output, that's pretty good as well. But she fails to sort of focus on the things that really end up mattering to Canadians. We've already talked on the channel about how GDP, or the total dollar amount of things bought and sold in the country, isn't the best indicator of how well a country is actually doing. It's really good for politicians and for central bankers to point at and say, look how well our economy is performing, but it does less of a good job on determining how well is this economy actually serving the average Canadian. Instead, I prefer to look at GDP per capita or GDP per person. This is a broadly accepted measure of quality of life for the citizens of a country. It relates to, well, how much money the individuals in that country make on a per person basis, right? It takes the total amount of buying and selling that goes on and divides that by the amount of people in the country as a rough measure of, okay, what's the quality of life in this country? And you can see some different sort of numbers here. And this is where we are today. It's the first time we've had a meaningful dip below actual growth in GDP per capita since the great financial crisis, which you can see right here. Again, this is a broad indicator, but when we're hovering around this line right here, that's around 3% GDP per capita growth per year. So every year, people's quality of life in general is increasing by 3%. And there are two things that can make this percentage go down like it is right now. The first one is you have less GDP growth in general, and the other one is if you have high population growth relative to your GDP growth. Of course, for the GDP versus the amount of people in the country, if you have more people in the country, you're dividing that GDP pie across more individuals. But increasing the population in a country, if you're just looking at the main GDP number, the total economic output of the country, the top line number, well, that looks pretty good, right? You add a whole bunch of more people to the country, you have more people buying things, more people selling things, more economic activity going on. So in theory, your GDP should be boosted. We've called this human stimulus in the past on the channel. The adding of people to pump up GDP numbers, some would say artificially when you consider what GDP means for the average Canadian on a per capita basis. And now both sides of the equation are taking a hit, both the GDP side and the per person side, right? We just got the numbers in for the second quarter of 2023, and well, the economy didn't grow. It just was flat. It stagnated. Keep that in mind. And BMO's senior economist says that, well, GDP is essentially flat, and that's even weaker when you consider that the population is exploding at a 3% per year run rate. You should be expecting to see huge GDP growth if you're using that kind of human stimulus. And when you look at these two sides and look at the real GDP per capita, it's no wonder that so many Canadians are feeling like the quality of life that they're experiencing is deteriorating. That's because it is, right? And to make matters worse, now with this whole Canadian-Indian conflict, there's a chance that this human stimulus for the GDP via population growth could slow down further, including the absolutely massive and profitable for Canada's GDP international student industry.
Look, international students are a credit to this country, Mr. Speaker. They are the future of this country, and they are an asset that is very lucrative, and we cannot let them down. Clearly, we need to work with provinces to make sure that they have proper housing, and we have to crack down on agents that are giving them false hope across the country. But let's not make this a partisan issue.
Now, I don't know if that was a stumble, but it seemed like he immediately realized that what he said as he was saying it wasn't something that he should say out loud. But he wasn't wrong about what he said. It's absolutely true that this is a big industry, by this record accounting for $22.3 billion per year of a contribution to that GDP number we were talking about. So economically, for big businesses and private education institutions where students or international students are paying almost double tuition to attend, as well as big companies who benefit from increased labor supplies, squeezing all the juices you possibly can from the international student cash cow is hugely beneficial for these big industry players. But for the people who are the victims of this industry, the story is a lot different, and that's the international students themselves. They're paying double tuition, often coming from rural communities in other countries, where in some situations their families are literally betting the farm on their child, sending them to Canada to make it for the family. But the reality that these international students are sold while in their home countries, well, it's a lot different from the reality on the ground in Canada. Oftentimes these students are exploited by diploma mill schools and to a certain extent exploited by Canada as a nation as well, cramming these students into expensive yet small living accommodations, all for the benefit of, hey, let's pump up our GDP. All this is to say that without the rocket fuel of low interest rates, quantitative easing, and human stimulus that we've been talking about, continuing to boost the biggest industries in Canada, like the housing market, I think that Canada's continued economic growth seems less and less plausible, and the economic growth per person, that real GDP per capita, that seems even less encouraging, and that's the important metric, right? The average quality of life for Canadians. That is the stag in stagflation, what the Bank of Canada says is increasingly likely to happen, that the stagnation, the slowing down, the pausing of growth in the Canadian economy. And the second part of stagflation is inflation. But you might be saying, well, Russell, hasn't inflation gotten a lot better? I've been on social media and I've seen some politicians saying, hey, things are actually going pretty well on that front. I've seen a lot of victory flag waving saying, hey, we've tamed inflation. Look at Mark Garrettson here saying this is the result of the government working hard to combat inflation while implementing policies to support those most affected by it. Look at Canada's inflation rate, we're 2.8%. Look how well we're doing. And this is the same sort of message that was shared by Chrystia Freeland herself.
Inflation in Canada has come down. You didn't ask me about this,
but
Matt. I
you
can't believe it, okay? Inflation, we had our inflation number on Tuesday, 2.8%. Isn't that great? Yeah, it is. Okay, we are now within the Bank of Canada's target range. This is huge. It's come down from 8.1% last June.
But about 2 months after these tweets and clips, it seems like that victory flag waving might have been a little bit premature because we saw that, well, inflation ticked back up to 4% in Canada during the month of August. That brings us back out of that 1 to 3% safe zone for inflation that the Bank of Canada is targeting. But where inflation goes next is something we don't really know. Nobody has a crystal ball. That's unknown. But one thing is certain, that inflation is far more dangerous now than it was even when it was at its peak of 8% just about a year and a half ago. The reason? We've run out of dry powder to use to fight against inflation. Just before inflation was peaking at 8%, sort of around this time, the Bank of Canada's policy interest rate was at 0.25%. That's right, the percentage that interest rates were just about a year and a half ago, set by the Bank of Canada, 0.25%. You can see that sort of earlier here, 1%, right? Now, when they started seeing inflation peak, they were like, okay, inflation is high, that's bad, but our interest rates are so low, we're stimulating the economy so much. If we pump up the interest rates, that'll slow down the economy and it should slow down inflation. And that's exactly what they did, raising interest rates at the fastest rate in recent memory. So they had a lot of ammo to fight inflation because they could raise interest rates like this, and not only raising interest rates, they could also continue to push interest rates higher by continuing their quantitative tightening. This is the opposite of quantitative easing. Essentially, it's the Bank of Canada letting the bonds that they hold on their asset sheet roll off, or they don't renew them, right? They just let them expire. This results in less demand in the bond market because they're not buying bonds anymore, and that means bond prices go down, bond yields go up, and interest rates across the economy trend up. We've talked about all of those in your calculations before. I'm not going to bore you with that right now. But now it is a totally different landscape. The Bank of Canada doesn't have this dry powder anymore. Each additional quarter percentage point that they raise interest rates, the pain is amplified for Canadians. Some homeowners have seen their mortgage rates double, right? With many people facing renewals for the first time since this interest rate increase over the next year or two. Canadians are already economically struggling, and the Bank of Canada has way less wiggle room to raise rates to fight against a resurgence of inflation, right? Every action they take to tame inflation will mean more hurt for the Canadians who are dealing with the impacts of their decisions. That's why if we were to see a situation where stagflation happened in Canada, well, that would be a very bad thing, especially when we already have interest rates so high. We can't just go in and stimulate the economy when we have stagflation, because then inflation would go up, even if we generate more economic inputs or more economic activity by lowering interest rates. Well, that would only solve one half of the problem, and inflation would skyrocket. You can see how the Bank of Canada and the federal government are kind of between a rock and a hard place here. But it makes sense that this is something that at least the Bank of Canada is monitoring right now. As of December 31st, 2022, they put it at about a 30% chance of happening. Now, these are the most recent readings we have for it. They might think now that stagflation is a little bit less likely, but I just thought it'd be something to put on your radar, that if this were to happen, it could be something really challenging for Canadians. And I'm curious what you think about all of this. Do you think that the Bank of Canada made a wrong turn at some point? Do you think that some blame lays on the federal government's policies across the board, economic, social policies? Or have I missed something entirely here and I'm getting something totally wrong? That's okay too. Let me know down in the comments. I read every single one. I try to get back to a bunch of them. Subscribe to the channel if you haven't already done so. About 50% of the people who watch these videos aren't subscribed, so if you could do me a solid, if you got any value out of this video, click subscribe. It helps me out dramatically. And with all of that said, thanks so much for watching this video. I really hope it helped you out at least a little bit, and I'll see you next time.